Okay, welcome everyone to our fifth webinar in Upskilling series on an important topic of understanding debt financing in real estate. I'm Sheetal Bilkar, founder and director of UBAC, and I'm Naredco Mahi, VP East, and also leading the skilling initiative for Mahi. Ladies and gentlemen, it's my absolute pleasure to welcome Mr. Prateek Jain, Senior Director, Capital Markets, JLL India. With 16 years of expertise in real estate financing, urban infrastructure, and construction finance, Prateek has established himself as a leading authority in the industry. His impressive track record includes scaling up businesses and client relationship, managing asset portfolios, and successfully financing over 40 investment opportunities worth over 1.5 billion USD. Quite impressive. Prior to JLL, Prateek has served as Group Executive Vice President at Yes Bank Limited, where he played a pivotal role in setting up and growing the business in Western and Eastern India. Throughout his career, Prateek has demonstrated exceptional leadership, strategic thinking, and a deep understanding of complexities of high-end capital-intensive projects. So, without a further ado, let's hear it from Mr. Prateek Jain. Over to you, Prateek.
Thank you, Shridharji. It's quite a pleasure addressing a forum like this, and that too on a topic which is very close to what I've been doing. It's always good to share knowledge, right? And looking forward to a greater interaction in this session. The way I have kept this session is the idea is we take each one of the interested participants over a journey of financing and help them in catching up how a real estate financing, whenever one come across a word called debt financing, capital raising, how do they interpret it, how it is useful in their practical day-to-day real estate transactions. So I've kept it very lucid, happy to answer any kind of queries that participants have, and we can take it from there.
Yeah, hi, Prateek.
Yes,
Am I audible? Yeah,
yeah,
okay.
absolutely.
So I think you begin your presentation. I can see mainly our Naredco Secretariat and Sheetal and me on the participants list. So, but this is a recording which we'll be sharing and will be available to all members of our Naredco team, Mahi and otherwise, and shared pan India. So don't worry about the number of participants, but please continue with your presentation and explaining the important concepts, terminology, and then how does one go about understanding this whole concept of debt financing in real estate?
No problem. I think that's fair
Yeah.
enough. I'll just,
Okay.
yeah. Just let me know if you can see the presentation. Yeah.
Yeah, we can.
Yeah. So I'll just quickly come to the topic. Whenever we talk, yeah, from a financing perspective, whenever one says that real estate as an asset class, as a project, right? When it comes to a lender, it can be bucketed into three buckets. First is the residential real estate project that you are looking to finance. The second is the commercial real estate project, or the third is the industrial real estate projects, right? Each of these projects, whether it's commercial, industrial, or residential, have their own nuances, have their own construction timeline, payback timelines, right? For example, projects like residential projects are built to sell, which means you will start a project and you will start selling the units also. So you will start recognizing and collecting revenue at a very early stage. Whereas a lot of commercial project and industrial real estate projects are uh, in a shape where you build the whole asset and then you lease it out, right? So you'll build the whole commercial building. And once it is built, once you have all approvals, that's when you will lease it out. So your revenue, your cash flows will start coming in at a very later stage. So depending on what kind of project it is and when the cash flows are coming, a banker would take a view on it and accordingly determine what kind of structures or conditions needs to be put on, right? So the objective of this whole discussion is to understand the development life cycle, right, of an asset from an asset perspective. What kind of financing instruments are there when one talks of financing each of these assets, right? Characteristics of these instruments, you will have various kinds of products, loan products, which you may go and end up interacting with a banker, right? Now, which loan product is the best suited for which asset class at which developmental life cycle, we'll try and cover that. Key terminologies that we'll be using in a financing piece will help you to build a basic understanding when you're talking to a banker. Not only that, even when you're addressing or you know, in a group wherein you are having a discussion on financing a project, these key terminologies are must to know. It helps you to understand the context of discussions, right? Next is the categories of capital providers. For each kind of products, as I said, there'll be different capital providers. There is no one shop which gives you all solution. Depending on what you want, there'll be a different set of capital providers, right? And lastly, I'll try and impress upon, when you go about raising money for your real estate project, right? What are the things that a lenders look at? How does a lenders look at when they're appraising a project, right? So let's start with it. I think the first thing one has to see is the development life cycle of an asset. So how does you conceive any project, right? It starts from, first piece is identifying a land parcel, purchasing that land parcel. Now this land parcel can be agriculture, can be industrial. You need to then convert it to the right usage, right? So if it's industrial, you want to build a residential thing, so you will get into conversion of it, right? Then you will make a design, a planning of what you want to actually build. What is your layout? What's your size? What's your specs? What's your design? Once you have done that, broadly agreed to it, then you apply for approval. Once you have approval, that's when you go ahead, start construction, and essentially build it, complete it, and hand over the project. That's broadly the developmental life cycle of any asset you look at, irrespective of whether it's residential, it's commercial, it's industrial. Now, this is on a life cycle piece. On the funding piece, right? Whenever you're talking on any kind of real estate project finance, broadly, there are four sources from where the money will come to build this asset, right? The first source is the equity. Equity is nothing but what you as a promoter or a sponsor to the project, you are putting in to build the project, right? Your contribution, your money that you're putting is your equity, right? Then the next piece to fund this real estate project is the debt, the bank loan that you propose to take on this project to help it complete construction. The another piece, which is also equally important, is your cash flows that you expect to generate from the sale of the assets. For example, you are building uh, you're doing a residential development. So you'll buy a land, you will build the building, you will sell the building. So right from buying the land, wherein you will put your money as equity, you will take bank finance to construct the building, and in the interim, you'll keep selling. Now, whatever cash flow comes helps you to complete your construction requirement. So cash flow from sale of assets also becomes equal important parameter for your funding mix. And of course, there is something called mezzanine. What is a mezzanine? We'll discuss this as we go in the session. It is something between a equity and a pure debt. So on one side, you will have a promoter equity. On the other side, you'll have a bank debt. And in between, a structure of a mezzanine product will fit in. Whenever you talk of any kind of project financing stuff, there are a couple of key terminologies which are very, very common and is required and is probably used by all uh, parties who are dealing in it, right? One is cap stack. Whenever we say cap stack is nothing but how is your total capital being divided? If I need to put 100 rupees to build a project, how much is coming from equity? How much is coming from debt? How much is coming from cash flows of the mezzanine? What is my capital structure? What is my cap stack, right? What is my structure of the capital that I've totally, the total outlay which I have for the project, how it is being funded by different parties, whether it's equity, debt, cash flows, customers, mezzanine, right? Next is TPC. TPC is nothing but the total project cost. So one needs to first assess what is my total project cost. It is including of all possible cost from land acquisition to pre-approval to construction, licensing, architect, design, sales, marketing, interest during constructions, right? All kind of cost. MOF is nothing but means of finance. So on one hand, I will have my total cost. On the other hand, I will have a breakup of how I'm planning to fund it, right? Which are the sources through which I'll be funding it. So I'll have a total project cost, which is my TPC. Then I have my MOF, which is my means of finance. The other important, a very locally used, commonly used thing is what is my debt equity ratio, which is nothing but for every 100 rupees of project cost. If I am putting a 50 rupees to build that asset and a banker is putting a 50 rupees to build that asset, then we are saying that we have a debt equity of 1:1, right? Which means both of us are putting a equal money to complete the asset. So a debt equity ratio is nothing but what is your contribution vis-a-vis the contribution from other sources, which is debt mezzanine over a project life cycle. ROI is nothing but rate of interest, PF is processing fees. So whenever you go, generally any kind of, when you say cost of capital, cost of debt, right? Cost of debt essentially would comprise of what is the coupon, what is the ROI that the lender is charging to you, and of course, what kind of processing fees you are paying at the time of sanctioning of loan. This put together, you will help you arrive at your cost of capital to obtain that debt, right? IRR. IRR is nothing but what's your internal rate of return. To put it simply, if I am putting 100 rupees in a project and I would only invest 100 rupees if I am expecting that this 100 will only give me a positive cash flows after completion of the project. So 100 will only give me something which is more than 100, not lesser than 100, right? So if I'm putting 100 rupees and I'm getting 120 as return or 130 as return, over a period of life cycle of 2 years, 3 years, I will make a mathematical calculation of what is the return that my project has generated, my investment has generated. So if I put 100 rupees, I've got 20 rupees over a period of 2 years, right? So broadly, I can say that if I have to put it probably in Excel, I would say that I have earned a return close to 9.8%, right? On a yearly basis, right? So what is my project IRR? My project IRR or a IRR of any kind of investment that you're doing is nothing but what is the return that investment is bringing up to you at the closure of the project. The next is whenever you are talking of taking a loan to help you to build asset, this is not, you talk of loan tenor. Loan tenor is the total tenor of the loan. What is my loan? So do I need a loan? If I'm speaking to a banker and I say, listen, I think I'll take 5 years to build an asset, right? Can you give me a 4-year loan? It doesn't make sense, right? Because you'll take itself a 5-year period to build the asset. So let's say a banker sanctions you a 6-year kind of loan. So your loan tenor is 6 years. Obviously, when you're building an asset, your cash flows don't come immediately, right? You'll build the asset. After some time, you'll start selling it. That's when the cash flows will come. So there'll be some kind of moratorium which will be given by the bank. What is moratorium? Moratorium is that, listen, you draw my money, you draw the debt, build the asset, right? But you don't need to repay me for first 2 years or first 18 months or first 15 months, which means whatever money that you are putting as equity, whatever money that I am putting as debt, let it go to the project, let it complete the project, build the project. And as and when sales start, you can start taking some portion of that collection and help it to, build the asset. And some portion you can start paying me back my loan. So moratorium period is nothing but a holiday, which is a gap which is provided by a lender during which you don't need to service any obligation to them, especially the principal obligation. Of course, you will have to service the interest, and this can vary lender to lender. But broadly speaking, moratorium is more to do on the principal side. You don't need to repay the principal instantly. You will get some holiday for it. DD and TSR is nothing but due diligence and TSR. So you will, whatever project you're underwriting, you will do a thorough due diligence, and then you will conduct a title search report, and you will see whether the titles. So these are very, very broad terminologies, which are very commonly accepted, commonly used in project financing, in real estate project financing, which is cap stack, TPC, MOF, debt equity ratio, ROIPF, IDC. Yeah, I think I missed IDC. So IDC is nothing but interest during construction. Why we take it separately? Because when you are building an asset, tomorrow you want to build a residential building. There is certain amount of loan that you will be taking to build this asset. Now, this loan, you will also have to pay the interest. Generally, whenever we calculate a total project cost, which I had mentioned as TPC in my key terminologies, TPC includes interest during construction as well, because even that is the cost I need to pay to my lender. I don't need to pay him the principal, but I also need to pay him the interest. So my interest during construction is part of my total cost. So these are the key terminologies that we use whenever we talk of any kind of project financing.
Sorry, Pratik, just one clarification, not clarification really. I'm just, it came to my mind. Two of your, terminologies that you are talking about. ROI, doesn't it also denote return on investment?
No, it can absolutely. But generally, when we talk of from a project financing perspective, right, we say
It's rate of interest.
yeah, what's the ROI, right? So it's rate of interest. If
Right.
we really
And
want to
same with
talk,
IDC.
okay.
For us in a real estate perspective, we are so used to saying IDC, internal development charges, and EDC, external development
Yeah,
charges.
yeah,
So
yeah.
when you said IDC is, this was, what did you say, internal?
No, it is
I'm sorry.
interest during
Interest
construction.
during construction. Okay.
So when you're talking to a lender, right, absolutely. I mean, the world is, I think, when you talk to a
I
lender,
know.
yeah.
So
So
we should
for
be
him, for
careful when we
him,
are using these terminal. I mean, these,
yeah. So when you
what do
talk
you
to a
call it?
lender, for
Yeah.
him, return on investment, the terminology probably most of us would use is IRR. What is the project IRR?
Yeah.
Internal rate of return, right? Whenever we say what's the ROI, we are generally colloquially, we are mentioning the rate
Rate
of
of
interest. When we
okay.
say what's the project IDC, which is project, what is the interest that the project will incur during its construction phase? So interest during construction.
Right. Okay. Thanks.
So once you start speaking the same language, the lender becomes very familiar, you become comfortable, and that discussion happens at a very mature level, right? Uh,
Yeah.
so when you
Thanks. Yeah. Okay.
Yeah, when you look at that, so I've just tried to classify this in development stages. So once you are hypothetically, let's take example that you want to build a residential asset, right? So your first stage is you will do acquisition of land. Now, this is a stage where land is being purchased, right? And one can say that, listen, I am purchasing 100 rupees land. I have for 50 rupees, but I need to borrow another 50 rupees, right? So this is the first stage where one can look at financing. So your first stage of financing is a land stage financing, where you need a lender to come and give you a land stage financing. It's a very high risks game, because at this stage you don't have approvals, you don't have a plan. It will take certain amount of time for you to acquire the land, get the approval, and launch the project, right? So at this stage, that's why we say it's the highest level of risk from a lending perspective, because your project is not even conceived at this stage. You're just buying a land. Now, who does land financing? Most of the private credit fund, or AIF, which is alternate investment funds, have shown interest to participate at a land financing stage with reputed developers, right? Because they're able to take that call that this developer has a pedigree. If they're buying a land, we will come and do a financial partnership with them at a land stage, right? And then we will ride the curve. Having said that, this is, as I said, in financing, and I think in life also, your return is proportionate to the risk you take. So because this is the highest risk category of financing, right, where you're funding a land is the highest risk category, your returns are also highest. So your ROI, right, will be the highest here. So the lenders would be charging the highest level of interest rate to fund these kinds of structures. What is your security? Your security is your land, primarily the land that you're buying. And also, depending on case to case, they may ask for additional collateral as well, right? Collateral is nothing but additional security over and above the project land. The second is post-approval, which means you have acquired a land. Let's say you put all your money, 100 rupees, you have acquired a land, you have all approvals in place. Now it becomes little simpler because there is no time that one is having to wait for them to get approval. So you have a land, you have approval. Now you go to a financial institution and say that, hey, I have a land, I have approval, I need a construction finance, right? Now this is in terms of risk, relatively better moderate risk than financing a land, right? Because by now you have done whatever as a owner needs to be done for conversion, for clear title, for taking approval, right? Now all you need to do is launch the project, get the cash flows, and be happy of it. So in terms of risk, it is moderate. Who are the capital providers here? You will have banks and NBFCs who will show interest to fund this project in terms of construction finance. So banks and NBFCs would be your partner in a post-approval stage, right? What kind of security would they look at? They will look at the same, the land and the construction, which is land and building, the construction that you're doing on that, right? That will be security. Again, on case-to-case basis, they may ask for additional security. And the third stage at which you would require a finance is a completion or a operational stage. So suppose you have a land, you bought a land, right? Then you took a construction finance and you did a construction, let's say it's a residential project consisting of 100 units. So you took X amount of money, built the entire 100 units, got the OC for the project. 80 of your units are sold. Now you have 20 units unsold. But today, the price discovery has happened because you have sold 80 units at a certain price. So you can, in a very structured way, arrive at the value of balance 20 units. Now you want to capitalize it, right? You need money and you know that these inventory will be sold in due course. So you can go to a bank and say, listen, I have 20 units, which is unsold. These are the average selling price for my 80 units. Therefore, this is the value of my 20 units. So against these 20 units, can you give me some money? So this becomes your inventory funding, right? In a residential case. Now, what will happen in a commercial case? In state of a commercial office space, you will make a full commercial building, you will lease it out, and you will have rentals coming in. So you will go to a bank and say, listen, this is my rental, annual rental coming in. Against these rental, give me a loan, right? So depending on what project you are in, whether you're in commercial, you're in residential, you're holding the asset, you're selling the asset, you can go to a bank and get yourself financed at an operating asset as well. Now, in terms of level of risk for a bank or for a lending institution, it is a least risk product because the land is acquired, the building is built, you have spent 4 or 5 years building it, you have weathered all the storms, all the possible hurdles which would have come during the project cycle, and now the project is ready, right? So it's a least risky product, and as I said, your risk is very equal to your return you take. Because the risk is low, the rate of interest charged is also very low in such products, in such categories. What is your security? Of course, your project, land and building becomes your security. So these are predominantly, structures depending on the development of the project.
Okay, again, might sound very silly, but what is the difference between an AIF and an NBFC?
Okay, so essentially, two difference, how they are governed, right? Who is the governing body, right? And what's the pool of capital? So NBFCs are generally governed by RBI, right?
Okay.
AIF is a alternate investment fund. It's a platform or pool where institutional investors or HNIs pool in their money with a fund manager who then goes and lend that money to depending on what is the end use of that fund, lend that money. And
Oh,
this comes under a purview of SEBI, right? So AIF would
of
come under,
SEBI.
yeah, of SEBI. NBFC would come under a purview of RBI, right? So more from a regulatory angle, and also the capital pool providers, right? In a AIF, you will have a lot of institutional investors, ultra HNI, giving the capital to the fund manager to deploy it further, right?
Hmm.
So
Yeah.
that's there. So moving
Right.
on to the next slide, I think. So this is broadly when you go to a bank, this is what you show to them, right? You will say, listen, this is my total project cost, which includes my land cost, my premium cost, my other approvals, my interest during constructions, right? So what is a finance cost is nothing but a interest during construction. My selling admin cost. So let's say my total cost is 394. And I have already acquired land by my own money. So by my own equity, I have acquired the land. So my total cost is 394. At the same time, I have paid 70 crores for the land, right? And of course, I've incurred another 5, 7, 8 odd crores across different stream. So my total investment today in the project is 79 crores, right? I need to incur another 315 crores to complete this project, right? So whatever you see on the top left side is the breakup of TPC. So whenever you talk of total project cost, one needs to understand what is the breakup of these project costs. So this is generally how you show to a lending institution that what is your breakup on the land, what is your breakup on the construction cost, what is your breakup on premiums, FSI, other approvals, finance cost. Then you have something called means of finance. What is means of finance? As I stated in my first slide is that if I need 100 rupees to make a project, right? How is that 100 rupees being funded? So means of finance is nothing but how much is coming from equity, which is nothing but promoter contribution. How much of the money is coming from sale of the assets, sale of the units, right? The residential units. And how much of the money are you anticipating to take to build the asset, which is your construction finance loan. So whenever you talk of a project finance, you talk of total project cost, then you try and break up the total project cost to see कि कितना पैसा किससे आ रहा है, how much is coming from equity, how much is coming from debt, and how much is coming from the customer as advances for the project, right? So broadly this. Any questions on this, or do we move to the next slide?
No, none from me. Let me check if no, I don't see any questions so far. Yeah,
Yes.
thanks. Continue.
Yeah.
So we have Dr. Ananta, our president, joined us. So Dr. Ananta, would you like to ask any question or talk to our speaker?
Hi, Ananta ma'am.
Hello, Prateek. Good evening, and thank you so much for sparing your valuable time to come and talk to all the girls. In fact, this is going to be recorded and it will be shared in a forum of 11,000 builders because Naredco has 11,000 members. And also, of course, our women's wing. I think the girls would benefit tremendously from this. Mahi Talks is something that we started about 2.5 years back. And we've been regularly doing it and getting subject matter experts on various issues related to the real estate sector, of course.
Right.
And this particular one, of course, Sheetal and Chitra are driving this. And it's absolutely wonderful to have you here. And so much of effort has been put in by you in putting all these slides together and everything. So I'm sure we'll all benefit tremendously. We'll listen to the recording also carefully later. And
This is
that's all.
YouTube. This is YouTube live also, ma'am. And
Yes, of
Pratik,
course.
this is
Of
going
course, of
YouTube
course.
live also, and people will be able to see
That's
this webinar
absolutely fantastic.
over and over.
Fantastic. So very grateful to you. I'm sorry I couldn't join in the beginning because I had a board meeting with the Share India. You must have heard of Share India.
Yes.
So they had their board meeting today. So as soon as that got over, I've joined here. So my apologies for not being here to welcome you at the
Perfectly
beginning
okay,
of the talk. But I think more and more women are joining the sector, Prateek, and it's support from men like you who can make that difference also and give them the confidence about exactly how professional the setup has become and the sector has become. So very grateful to you. Please do continue. I am sorry for the interruption in that sense because you must be having a flow as far as your thoughts are concerned, but please go ahead. Thank you.
Sure, ma'am. Thank you. Thank you. So I think broadly what we just tried looking at is that what are my key terminologies in real estate discussions? What kind of funding mix we talk of whenever we talk of taking up a project, right? And the idea was the different life cycle of the project, what kind of loan products or a debt product would you go and speak to a banker, right? So when you're acquiring a land, you will say, hey, I need a land financing, right? Which is again the riskiest and the most costliest. Then while you have land, you have all the approvals, you will go to a bank and say, I need a construction finance. Once you have built an asset, you will say, listen, I have an income generating asset. I have a office space, which I've built. Now it is giving me rental. I need a LRD, which is lease rental discounting financing, right? So now if we have to break up the whole thing between stages, now let's look at the stages. How does it work? Now, assuming that you are having an under construction project, which is a residential project in this case. So depending on the quantum, right, you can say what's your size, how big you are doing it. It roughly takes around, give and take, it takes 4 to 5 years to build a residential project, right? Any residential project, if you go to a banker and say that you will take 10 years to build, he'll be the first guy to say, boss, that there's something either wrong with the development thesis or with the project itself, right? So technically a real estate residential project will take 4 to 5 years to build. Now, what does it mean? For a residential project, it means that I'll take 5 years to build, but I will start having cash flows from probably year one or probably from 6th month. How? Because I'll be selling my units also. So when I launch the project, I'll keep selling inventories. I'll keep getting money. So that becomes my means of finance, right? For a commercial asset where people generally, they don't do a strata sale, they will build the whole office building and then lease it out. In that case, your cash flows will not come for 5 years, which means what? Because we have just looked at sources of funding. So predominantly there are 3 sources of funding: debt, equity, and customer collection, which means that in a commercial asset which you are building to hold and not sell, generally you will not have cash flows in the intermittent period. You will only get money when you have built the entire commercial space, because that's when you'll be leasing it out, right? Secondly, whenever you are doing a project financing, right, in most of the cases, I think I would rather say if there are 10 loan proposals which are coming across the capital providers, almost in eight of them, you will have land which is already acquired by a promoter, right? And now he's coming to you to take a construction finance. So whatever the capital that a owner puts to buy a land is called as his equity in the banking segment. So when we say how much equity contribution you have built, is nothing but how much money you are building to, how much money you are bringing to complete the project, and land is inherently looked as a equity contribution from the promoters, which means bank will not fund land. They would expect you to buy a land and then come back to them to take a construction finance, right? Also, if you would have looked at my previous slide, and I'll re-show you again, broadly, right? There is no strict parameter, but broadly, if 100 rupees needs to be spent on a residential asset, 20 to 25% or even 30% comes as equity, which means I will put 30 rupees as owner of the project, my money to complete the project. I will take 40 to 45% as debt, which means 40 to 45 rupees of the total project cost of the TPC. When I say equity percentage, it is on TPC. So my total project cost is 100, 25 I will bring as equity, 40 I'll take, 40, 45 I'll take as loan, and the balance 30 to 40% is what I will depend on my sales collection of the project to help me complete it, right? Now, one important terminology is DCCO, right? So you can call it a DCCO, you can call it a COD, which is nothing but commercial operation date, right? Or date on which you expect your asset to become operational. So whenever you're taking a loan from a bank, you need to tell them that what is the period by which you expect your project to become operational. Why? Because it is imperative for a bank to know from day one that if they are funding a project, what is the outer timeline by which the project will become operational, right? Because bank needs to give you money and take back that money from you. So DCCO is a very important consideration. It has a very, very important bearing on your loan. Why? Because if, for example, today is September 2024, I am building a residential project. I'll go to a bank. Let's say I've acquired a land. I'll go to a bank and say, give me a construction finance on it. Of all the discussion, one point would also be कि सर आप ये building कब तक खत्म करेंगे? I anticipate, building my whole product in 4 years and another 1 year extra to sell it. So I will say by September of 2029, which is 5 years from today, I'll be achieving my operations and full closure of it. So bank in their own appraisal, when they will, give loan to you, do the appraisal process, they will estimate that the project will see the light of the day by September 2029. Now, any delay beyond this, let's say for some reason you end up delaying the project gets stuck, you don't have right customer collections, there are other issues, will have an important bearing on how the banks classify this loan. So whenever you think, आपने काफी बार ये सुना होगा कि लोन NPA हो गया, stressed asset हो गया. What are these? These are nothing but where you feel that whatever was the initial envisaged timeline to build the project, you are not able to meet that. There has been delinquencies, you have defaulted on banks' repayment because of delay in project and delay in getting the cash flows to complete the project, right? Now, similarly, for an operational stage project, things will be very, very different. If you're building a asset which is already operational, a commercial building, let's say a large commercial IT building, right? Now, generally, a CF lender will come, a construction finance lender will come and give you a construction finance to build this asset once you have a land parcels with you. Now, once you build this asset, if you remember in my second slide, I had mentioned the risk return and the product. So construction finance is a moderate risk category product where I have, as a banker, I will take a construction risk, which means I will take a risk to stay with the asset for 5 years, help it build and sell. Now, once the asset is built, the risk appetite, the risk profiling gets reduced, which means it's not a risky product. I built the asset. Now all I need to do is rent it to right people and collect my rental every month or every quarter. Now, the most prevalent thing to do in financing is you take a construction finance, you build the asset, and once the asset is built, you repay your construction finance outstanding loan by taking a LRD. In case of this is true in case of commercial assets. So once you have your commercial building ready, you will let it out, you will get a certain rent. Against that rent, you can borrow money, and this money can be used to repay your outstanding construction finance loan. What is the industry standard generally? So for a LRD, lease rental discounting, it's generally 5 to 6 times of your NOI. What is NOI? Net operating income. So if I have a commercial building which is giving me a rental of 100 crores, net operating income after my cost and management charges, I'm getting a rental of 100 crores. Give and take, you will have financial institutions, banks willing to give you 5 times or 6 times of your net operating income as a loan in the form of LRD. तो 100 crore की अगर मेरी rental income है, I can go to a bank, and if it's a good asset, steady, good tenants, I can go to a bank and raise 500 to 600 crore of lease rental discounting against my rental assets, right? That is broadly the industry benchmark. So this is between an under construction asset and an operating stage asset. Now let us discuss on credit appraisal and due diligence. Now this is very important because whatever we have understood right now was more from the perspective of we being the equity holder, or we being the owner, or we being the project developers. So this was important for us to understand. Now, how does a bank look at it? How does a capital provider looks at it, right? So what is my credit appraisal and due diligence process looks like, right? So broad thing which a lender, and it's very important to understand, because if you can understand what your lender wants, right, you can have a very symbiotic and very good relationship with them, because you are able to deliver what they want. The expectations are set out and met, right? And there is no scope for frictions. So broadly, what a lender will look at when you go with a loan proposal is the first thing they'll look at is what is your pedigree, right? How many projects have you built in the past, right? How much have you developed? What is your general reputation in the market in terms of the buyers who are buying your product? What do they feel about it? What kind of track record you have in terms of repaying the loans of other lenders? So how many times have you borrowed from other lenders? Have you paid them on time? If you just remembered, I told you that there's an important thing called DCCO, which is there in my under construction stage side. So has there been a situation where you have not met your DCCO, which means you have not completed your project on time, right? So in general, what's your track in terms of building, in terms of selling, and in terms of repaying the loan? The second thing they would like to understand is what kind of equity contribution are you bringing in the project? If the project cost is TPC, total project cost is 100 rupees, how much am I bringing as equity holder? Am I bringing 25 rupees? Am I bringing 30 rupees? This is nothing but to ensure that the developer, which means you as equity holders, have skin in the game, right? Because if you have 100 rupees to be spent and you're putting your 25, 30 rupees vis-a-vis a person who is only putting 5 rupees and taking 95 rupees as loan, the chances of a person being more serious and committed would be the one who has larger skin in the game. So the banker would always want to understand what is your equity contribution. And I just referred that generally a 25 to 30% is what is being sought by bankers as a equity contribution to the project, right? Next, what they will look at is, you have a land, do you have all approvals to start construction? None of the lenders would want to get into except for a land stage lender, except for a stage lender who comes at a land stage. None of the lenders would want to get into a project where approvals are not there. So bare minimum, they will expect you, if you want to take a loan on your project, 3 things you have to ensure: that you have all approvals in place, right? You have met whatever it is required, whether it's your IOA, concession, environmental clearances, right? You have everything in place, and you are, let's say if your project is RERA applicable, you have done RERA registration, that's when a banker will get in to fund you, right? Next is what they will look at is what is your security cover. मैं 100 रुपए के प्रोजेक्ट कॉस्ट में आपने 25 रुपया डाला है, आप मुझसे 40 रुपया मांग रहे हैं, राइट? अगर मैं आपको ये 40 रुपया देता हूं, अगेंस्ट दैट 40, what is the security I have, right? Do I have 2 times of security, which means 100 rupees total project cost? Is it throwing bare minimum a 50 rupees profit? तो 100 rupees का project है और 150 का मेरा sales है, तो 50 रुपया मेरा profit है. Broadly, I'm just trying to make it a little simpler for all of you. So as a lender, I will say that, okay, 40 rupees is what I'm giving you as loan. On this 40, you will serve certain interest to me, right? And you will be paying this 40 rupees from your cash flows. So do I have sufficient cash flows in the project which can pay my principal and which can pay my interest, right? So that's the security cover a banker would look at. Generally, you will say what kind of security cover? Give and take, a reasonable security cover is anything between 1.75 times to 2 times. मतलब अगर मैं आपको 100 रुपए का लोन दे रहा हूं, I would expect the project should have a clear operating surplus of 2x to cover my loan. तो मैं 100 रुपए दे रहा हूं, तो 200 रुपए का सरप्लस तो होना चाहिए, जिससे आप प्रोजेक्ट से मुझे मेरे 100 रुपए भी वापस करें और मेरे उस पे आप ब्याज भी मुझे दें, और उसके बाद जो बचे वो आपके लिए as equity upside, equity profit bache. So most of the lenders would insist on a healthy security cover of 1.75 times to 2 times of security cover. The next important thing is, as a borrower, we should know that banks are not allowed to give money for speculative purpose, which means you can't go to a bank and say that, listen, I'm launching a project, right? Please give me money because I want to invest that money in stock market. It's a prohibitive use. You can't go and say to a banker that give me up money because I want to buy a land. Land is again a speculative purpose. So a banker will always look at that the money which they are giving you, what is the end use of that money? If I am sanctioning you 40 rupees, what is that? What is the end use of that 40 rupees? It should be going to the construction of the project only, and it should not go to any kind of prohibitive uses, is what again a bank will look at, right? So that's what I mean is when I say that the end use of the facility being sanctioned is clearly defined. That listen, I'm borrowing 40 rupees and this will go for supporting construction of the project. And of course, one of the key things that a bank will look at, irrespective of all other things, is the project land that I am funding, is the building that I am funding, does it has all approval? But does the land has clear title? Or there is some kind of encumbrance, there is some kind of cheese hole, there's some kind of gaps in the title. If at all there is a gap in the title, however good location you have, however good project surplus profits you have, bank will not be very encouraged to give you a loan. Because at the end of the day, they would want to fund only those assets which has a clean title and are mortgageable. So for example, you have a very large parcel of land, very strategically located, but let's say it's an agricultural land, right? By very end use. You can't mortgage a agricultural land, right? It's not mortgageable. So a bank would look at the mortgageability, the encumbrance, and the title history, and would want it to be very clean for them to go ahead and sanction your project finance. So this is broadly very brief introduction on how one looks at project finance, how they, what are the key things that one should uh, speak, think, and understand when they're doing these kinds of discussions with any lenders, right? I think that's broadly from my side. Happy to answer any questions that you may have.
Yeah,
So
I
Prateek,
can
I
see
have
one
a
question.
sorry.
Yeah,
Yeah, I
yeah.
have a question from Dr. Anshul Gujarati from Pune. The concept of a green finance is yet evolving. What's your take on this?
So this is, I would rather say that uh, green finance is a very, very important subject today for all the lenders, right? Because people, for whatever ESG compliance that most of the companies are today trying to follow and benchmark themselves, right? A lenders would prefer, a lot of lenders would have a special concession in interest rate if you are making a building which is very ecologically friendly, has consumes less amount of electricity, causes less harm to the environment while construction and operations. But having said that, the green finance market is very, very shallow in India. We are still at an evolving stage. There are not many lenders who have green financing back projects, back products, right? But banks are working towards it. A lot of banks are coming out with products, concessions, which in a way, incentivizes you to develop a better, efficient building. But it is still a very shallow market in India today.
Thank you so much, Prateek. Chitra, please go ahead.
No, I was going to be taking Anshul's question, so that was what it was. It's okay. Yeah. It was very interesting, Prateek. I mean, a lot of it we feel we know most of it, but you put it in such a structured way that, concepts are far clearer. So,
A very complex topic has been covered in a very simplified manner and a very
yeah, I think
logical
so.
manner. And like I said earlier, your slides are absolutely amazing, right? From the content to the bullet points to the colors that you have used. I think this is something that we would like to invite you for, probably again and again, because we have these not just Zoom meets and Zoom talks. We also have a lot of conventions, and we have a lot of these interactions, and it's like a moving circus which kind of moves from city to city, because gender integration in real estate is something where you actually need to get them and draw them to the industry. There's so much talent out there, you can't imagine, but there's a lot of hesitation which is still there, and that's what Mahi is trying to do. We're trying to change the perception, and all our Mahi women are, of course, all who've achieved the pinnacle of success in their subject. They're all subject matter experts. And so leading by example in that sense. So I think, Chitra, over
Yeah,
to
I
you
just
now.
have one question. Yeah,
Yeah.
one question, Pratik. In your very first slide, we talked about three kinds of asset groups. We said residential, commercial, industrial. So today, a lot of real estate developments are all mixed use projects. So how do you look at that? I mean, you then divide it into the residential component and the commercial component.
Yeah. I just try to make it simple for people to
Okay.
understand that whenever you talk of a real estate project, you have to understand the cash flow of it, right? To understand when my project will throw a cash flow, a residential project will start throwing cash flow from the date of launch. A commercial
Mm.
asset will throw a cash flow only once it is completed and leased out, right? So if I have to get deeper into it, then probably you will have multiple things, right? So you'll have a residential real estate, you will have a industrial real asset, you will have real estate, you will have a the warehousing, the data center
Yeah,
piece,
go
co-living,
down some
student
warehousing.
housing. But at the end of the day, broadly, what one has to understand that
Mm.
is my asset a cash flow generating asset where I am taking cash flow to construct it, or is it an income generating asset where I'm building the asset and then getting an income? And that's broadly how you will define your loan requirement.
Okay, but today there are also a lot of real estate commercial projects, where they are already expecting people to invest or buy into that project, similar to residential,
No, that
uh, you
absolutely
projects
right.
saying that you have a rental option and etc. etc. So they are giving them more options also to participate.
Absolutely. So as a
Yeah.
builder, as a owner, you always have a choice that if you're launching a project, whether it is residential, industrial, commercial, you always have a choice कि मैं पूरा बनाने के बाद बेचूंगा,
Yeah.
मैं थोड़ा थोड़ा बेचूंगा या मैं बिल्कुल नहीं बेचूंगा, right? When you
Mm.
are not selling at all, that's when you are building a commercial asset and just renting it out and getting a
Yeah.
rental income out of it. If you're building a commercial asset and you don't want to wait till end and take higher loan today, then you will start selling it piece by piece, floor by floor, units by units to investors,
Mm.
right? So
Right.
depending on what you want to do, you will classify the cash flows for it.
Mm. Okay, I can see one more question from Tina.
Yeah.
Tina Mittal's question is, if we get a land bank and just go for plotting, then also same possibility of finance is possible, not undertaking construction as such. She said it's a little off the topic, but would like some clarity on this.
No, this is absolutely within the topic. It's not off the top. Anything with finance for real estate is within topic. Uh, yes, land financing. If you have a land, right? If I've got your question rightly, that you have a land parcel, you want to go for a plotted development, can you get a financing for that?
Finance.
Absolutely, yes. There is no problem. There are a lot of banks who are or financial institutions who have product which enables landowners who has a land parcel and approval to do the plotted development. So whatever the money you need to build the plotted infrastructure can be taken on loan, and it can be a very, because these are very small tenor loan. A residential project will take 4 to 5 years to build, but a plotted development will take only 10 to 12 months to to get entirely sold out, because आपके पास land है, all you need to build is right
Mm.
infrastructure and sell the plots, right? So yes, it is, to answer your question, yes, it is available. There's no problem.
Yeah, but to be in a low risk category, then better is to get the conversions, get the land, get the plan approved, have all your approvals in place, and then approach. No.
No, so listen, as I said in my last slide, that my end use has to be well defined, right? When I'm going to a bank, I have to clearly tell them where I need money. A bank will not fund you money to buy a land. Now, let's say you have a land, you have got the approvals. That's when you're going to a bank and saying that, listen, give me a construction finance. Now, construction finance in this terms is nothing but a development finance.
Land development.
Give me a development finance to develop my land, right? I have a land and this is my project. This is not a residential unit based project. It's a plotted based project. I need money. A lot of banks will go for it. No problem at all.
Archana Vora has put up a question. She has redevelopment by society members. Then what happens? I mean, if I get your question correctly, Archana, are you asking what happens in a cooperative society kind of a situation where it's not an individual, but it's a society which is trying to raise the loan? Yeah, she says yes. So in the case of not having an individual, but a society, then how does it work?
So I think it's not about being individual or society. One has to also understand that as a lender, I would want to deal with one developer or one owner, right?
Okay.
So while banks and NBFCs are very happy financing the developers for their upcoming project, right? They are happy financing a developer who is redeveloping a society, who has got into a JDA with the society to redevelop it, right? Sorry, a development agreement with the society to redevelop. They are happy to fund a developer. But a situation where the society wants to get into redevelopment by themselves by appointing a PMC contractor and a bank to fund that is very difficult because you have multiple owners with whom the bank would have to deal with, right? Your rights and duties are not classified. If tomorrow the project doesn't takes the shape and the bank money is not repaid, whom does the bank goes and collect money? Its dues from?
So they goes into a high risk category.
It goes into a, yeah. So banks would not be very keen, and I'm not sure that even bank would do that, right? In my experience, I can't recollect anything where a bank has done, a large scale self society development kind of funding. Of course, there are certain cooperative banks who do give some kind of support wherein you can get a PMC contractor and you can have a reasonable developer or someone, on whom they can benchmark that these guys will deliver the project if the funds are made available to them. But it's very difficult in general.
So continuing the question, Archana has put a comment asking, what if a committee is formed or if there is an entity which takes responsibility, even then it would be considered a high risk?
It's a high risk, ma'am, because at the end of the day, as a banker, if you would have looked at my PPT, I said in the last line I said is for a bank is to have a clear title ownership and free from encumbrance. Now, if I have to deal with one owner, right, I can establish his title, his encumbrances, right? And if there is a litigation, there is a delay, I can pinpoint that one guy, right? But tomorrow, if I have, as a lender, I have to fund a society for redevelopment, something goes wrong, some members dissent, some members take a, different course of action, and I have given some money. Whom do I go to recover my money? I can't enforce my rights on the committee, right? Because the committee will say that we are just the body, we are not personally liable for the loan, right? So it's a different equation.
Yeah.
So I would still say it's a high risk category, and one can look at a private credit market to get these kinds of financing.
Right. Okay. Thank you. Any other questions, dear participants? Okay. I don't see any questions coming in. And Prateek, it was wonderful. I think for me, it was a big learning, and I'm sure all our participants share the same sentiment. And we thoroughly enjoyed your PPT. As Dr. Ananta said, it was very well presented, easy to understand, very nicely composed. So we look forward to having more interactions with you. And thank you so very much for clarifying, something which is the minute you said that financing sounds like something we don't know so much about. But today you made it so clear and simple for all of us. So thank you so much once again. And over to you, is Sheetal back? Yeah, and thank you once again. I think Sheetal is probably
Thank you,
not
Chitra ji.
there
Thank
right now.
you, Dr.
Yeah.
Ananta. Thanks for this. I think it's a great.
Thank you, Prateek ji. And I would just like all the viewers to know that it is on YouTube. And so some of you have been requesting for the recordings. It's on YouTube, and please go ahead and see and share. And thank you so much.
Thank you, ma'am.
Thanks.
Thank you. Thank you once again. Bye.
Bye.